Hey traders, this is Scott Barkley. This is about a 15-minute video on how to prosper in a ranging market, and especially if the market is turning on a dime inside that range. And yes, there is a trade setup. So there's a disclaimer. I'm not going to read it because of the time, but there it is. So there's no rocket science in the forex, everybody. Each piece is easily understood, it's logical, it's sensible, but there are lots of pieces, and that's where most traders get it wrong. They think a couple of things will make them a trader, and it won't. You need to learn the why of the market. So the forex market only trends 30% of the time, and there are long spaces of time when it does not trend even at that percentage. So that means that a trader must have a trade setup for a ranging market, and most of the time it will become your go-to trade setup. Forex pairs range all the time, but sometimes they start flipping on a dime inside a range, and you enter your trade setup and then bam, it reverses on you and goes the other way. And no, it is not the broker taking your stop. Now this pattern is especially prevalent in the summer trading, but occurs all year at different times. But professional traders can really prosper in these conditions, but the retail trader usually gets bashed. So what do we look for? So here's a few examples of ranging markets and them turning on a dime. All right, so you can see I got a range on here, this big range, and you can see there are little boxes here where the market turns on a dime like this. It goes up to the top, turns on a dime, turns on a dime, turns on a dime, goes back up, down in here, and down, turns on a dime. Now, by the way, when you hit a bottom of a range, especially if you got a sideways market, typically sideways market continue in that way, but at the bottom of a range they won't do it, nor will they do it at the top of a range. All right, so you can see, especially in this little box here, up, down, up, down, up, down. You know, most traders get stopped out in that area right there. So that was the euro dollar right there. Let's take a look at another one here. Here's the Aussie dollar. You can see it was ranging trending pretty nicely over here. And then we go into a big sideways movement with boxes. Okay, so you know, down the bottom or the top, down like this. See, real quick movements like this, boom, doom, doom, like that. You know, those are things that traders get stopped out on all the time. Here's another one. It's the euro yen. You can see the same thing, even more dramatic here as it turns on a dime inside each of these boxes. Turn, 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 turn. So these are called Darvas boxes, and they're areas of defined support and resistance, but they are big enough to trade if you don't buy at the top or you sell at the bottom. So let's look at them again. Now there's a huge key here, and it's the T3. So I want to make a point of that. You can see the T3 just continuously moves to the downside until it goes up. You see that? All right. So it's not trending in here. It's just doing a box, right? Then doing a box, and then doing a box. Remember, at the bottom of a range, they won't continue to the downside. Right? Makes a turn, and up they go. So you can see here very clearly that the market has, when it continued to go here, even though there were movements up and down, up and down, and down, but when it finally made the turn right here, you see, it instantly tells you there's the turn, and you become a buyer here. All right, so there you go. All right, so here we are. We got this chart up here. Which way now? We're in a sideways movement. We have a Darvas box, and we got into this box going up. That so typically a trader would think you're going up, but the chart tells you something totally different. Notice the T3 right there. It said you just broke through the T3 and you're on the other side of it. Huge, huge, huge. Then you look down here to confirm it. MACD says not only have you broken to the downside, you have a zero trend line, a zero line break to the downside. You're a seller here. So if you try to buy here, you're going to get whacked. And no, the broker didn't stop you. Doggone broker, stop me out again. No, he didn't stop you out. You got to read the charts. The charts are talking to you, okay? So again, here, they're really, really trending nicely right here. And then you get over here and you can see that the T3 held all that movement here, but it didn't turn to the upside yet. You see that? Kept on going. And we have see, it hardly made the move at all to the turn to the upside, but it actually made the turn there. And from this point on, you are a buyer. You see that? All right. Especially when you break above here. All right, coming down through here. See how we broke the T3 and down she goes right there. See this right here? We're above it. We're looking for that move right there. See that? Notice the MACD is also showing that. All right, so you know, the chart is talking to you at all times. We have to learn the charts. Here, we're trending down. You notice how the T3 holds this to the downside, holds it here. Oh, we broke to the upside and made the turn. See that? You're officially a buyer right here. Oh, over here, we turned to the downside. See that? And look at the sell. Right? Oh, we turned to the buy side. There we go. You see that? All right, so the market's doing pretty big swings here, but the T3 is giving you a heads up on all of them. Look at here where you broke here. Look at the reaction to the big boys. See, the big boys took advantage of that. They saw that all come together. There's only three pieces of information here. Not a one is a trend. One of them is a T3 break. We got the MACD going to the downside, and we're at the top of the range, so that the box won't break to the upside, it'll break to the downside. See that? Three pieces of information there, and the T3 was critical in all of that information right there. All right, so what is the one key that will help me more than anything to recognize when the turn is coming, okay? And I'm not talking about the total turn, I'm talking about the turns inside the boxes here, and it's the dollar index, okay? So take a look here. What do we see? Most people will see, I see the rabbit. So focus a little harder, and what you're going to see is two kids looking at each other. And you go, oh man, right? And that's a way your brain tricks you, okay? And you gotta be careful of that sort of stuff. So let me give you an example of that. So here's a dollar index, okay? It is the key to unlock the door to these turns, okay? You see how it's turning constantly in here? See, all right? Now, most traders will have this as a trend, right? That's what a trader will do. That's a trend. It's not trending. Right? It looks like it's trending, but it's a rabbit. That's a rabbit. It's not doing that at all. What's it doing? Box to box to box. And then we hit the top. There's a little box up here, as you can see, but that box up there is at the top of the range. All right, so it's not going to go up. It's going to turn to the downside. See how the T3 told you? Hey, don't even think about going up. You're going down. And down she comes right there. Right? And then we get another box down here to the downside. Now, Darvas boxes are big boxes. You see they're big. They're not 20 pips or they're 60, 70, 80 pips type stuff. And they statistically resolve themselves based on the last move. So you got in here going up, you're going to continue up, okay? Pull back here, up we go, and you know, this could be even a big box like this, all right? And ultimately we went up, we're going up, and the T3 tells you you're going up, see that? And there we go, all right? And we make the turn to the downside, there we go. What are we going to do out of this box? We're going to come down here. So see, this is tradable if you sell at the top. Right? It's not tradable if you sell at the bottom. You get stopped out. See that? Sell at the bottom, you get stopped out. Sell at the bottom, you get stopped out. You sell at the top. Okay? Over here, you buy at the bottom. 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 See? It's a job of a trader to know what to do when he sees these patterns in the market. So the dollar index triggers the reversals on the other currencies, and especially in the dollar pair. So for instance, you're trading the pound dollar to the downside, okay? And the dollar index has been going up. It makes a turn like this. This will instantaneously make a turn up. Right, based on the dollar index. In fact, at the big boy level, they're watching that dollar index like a hawk, and they make the turns when it makes the turns. Right? So Darvas boxes and poles are what you're looking for inside a ranging market. So once you've figured out that you are ranging, which by the way is 70% of the time, you look for the boxes to form, and then your timing for entering is the dollar index. All right. So the next big and most important setup is the flag pattern, and we call it the pole trade, okay? So the pole trade is found in the 10-minute and the 60-minute chart, all right? The pair first creates a flag with a hard top and a hard bottom and a sideways move, all right? It's called a flag like this, all right? And the pole is what we're going to measure right there. So how we got in is how we're coming out. So there's the flag right there, okay? All right, so a flag waving in the wind. It's just the opposite if you're going down, all right? It's called a flag pattern, all right? Whichever way you went into this flag creates a high statistical probability of going out that same way. In fact, it's about 90%. You measure the movement going into the flag, and whatever that is in pips is the target going out the other side. You wait for a break, hook, and go, and then the momentum candle to enter. This keeps false breakouts to a minimum. So let's look at the pieces of this trade, and remember they're found only on a 10 or a 60-minute box for best results. Remember that a pole is a small movement, maybe 30, 35 pips or something like that, up and down, but a Darvas box could be 60 or 90, right? So here's the flag, you can see it right there, very easy to see, and it's created by big boys. Remember that 78% of everything you see in a chart is created by big boys, right? So every time it comes to the bottom, somebody throws money in, somebody throws money in, somebody throws money in, all right? There are no sellers. Why did they do this? Because they want to keep this movement in play, all right? Once a movement is in play, bankers will do everything they can to keep it in play, all right? And so will professional traders just follow them, all right? So there's the flag pattern. So all we got to do is we measure how many pips it took to get in. This is called the pole part, okay? From this bottom until the bottom of the flag, all right? Whatever that is what it's going to do to the upside, all right? So here we go. Whatever that is what you're going to do up here to the upside. If that's 62 pips going into the flag, it's going to be 62 pips coming out. If it's 94 pips going out into the flag, it's going to be 94 pips going out. If it's 46 pips going into the flag, it's going to be 46 pips going out. And most of the time, it's to the pip. All right? All professional traders know how to trade this, all right? And it's one of the keys to being successful in a sideways market, which, by the way, I'm recording this in the second day of June 2018, all right? So what does that mean? That means June, July, and August are summer months, mostly going to be ranging. So this is something you really got to get a handle on if you want to be successful. And you can be very successful in these markets if you learn how to trade with the big boys, all right? Now, once we get a break of the flag, we're looking for a break, hook, and go. So there's our area that's our opportunity. There's the break to the upside. And then it comes screaming back down. Now, most traders don't realize that a break, hook, and go is a statistical probability 90% of the time. So as soon as it turns and goes to the downside, they go, oh no, it's not going up, oh no, I'm going to click out. And they click out for 5 or 8 pips. And they go, wow, that's awesome, I'm a winner. No, you're not a winner. You won the battle. Well, you lost the war, because now you got to be 90% correct for the rest of your life in order to be successful, right? Or in other words, you have to be the best trader on the planet, right? So if you can't say, I am the best trader on the planet, then you need to learn this, okay? So it does a break, a hook, and then it goes in the direction of the pole, right? You see that? All right, so what about the momentum candle? Well, in our charts, it's very easy. It's hard. In fact, you can't see it in any other charts, but in our charts, we're measuring momentum behind the scenes. The first heads up comes with a white dot, and that white dot tells us that the big boys have entered on the 60-minute chart. Now, the big boys enter and create the initial move, but in order for the move to continue, it has to have follow through. And there are 12, 15 banks that create the move, but it's the 500 to 800 banks, sovereigns, and hedge funds which creates the follow through. We want to trade with the follow through, all right? So you can see this very first big candle right here goes up about 30 pips. It comes whoa, screaming back down 50. You get stopped out on that candle, all right? So if you wait for the momentum candle, this is where the money comes in for a sustainable move, then you're going to be just fine right there, all right? So I did a little study last February. Last February we had a big ranging market. It just was sideways. Everything was sideways. And so we trade 19 currencies over here at ProAct Traders. And I went and did a study on all the poles that were in the market in a 7-day period from the 2nd day of February to the 9th day of February. That's 7 days. But remember, there's only 5 trading days in those 7 days. And those 5 days, there were 66 poles on those charts. If you only made 30 pips, and most of them go way over 30 pips, you can see this one right here, it went 1, 2, 3, 4, 120 pips. Just using 30 pips right here, there were 1,989 pips available to the retail trader, just trading poles. Nothing else, sideways movement, all right? And you can see the difference between a Darvas box, all right, which is a big box, all right, and a pole. It's very, see how tight it is? It's a very tight movement here. These are poles, not Darvas box. A Darvas box, you might be looking at that. There's a Darvas box right there. See the difference? All right. All right. So, you know, once again, remember that the T3, it told you you're a seller, you're a seller, you're a seller, you're a seller, you're a seller. Oops, you're a buyer right there. See that? How it tells you? It's so clear. Oops, you're a seller right there. So a seller with a bear flag, we're looking to finish this movement to the downside. See that? So the chart is talking to you at all times. So here's what you need to do. You need to spend some significant time on some charts looking for these patterns, okay? I'm not talking about I did it for 15 minutes today. I'm talking about spending 3, 4, 5 hours for a couple of days in a row. And see how the T3 will help you in your decision process and teach you how to recognize a Darvas box and also a pole. Right? Because in a sideways market, they're going to be your go-to trade. If you're trying to trade a moving average crossover or something like that, they only work in a trending market, which is only 30% of the time on the high end. See? So spend the time, learn how to do this, and you should have a pretty much more successful summer if you will apply this lesson into your daily trading. Hope that helps you. We're going to see you in the live room, we hope, and I'll talk with you soon.